I mean, would you agree that there are lots of kind of interesting bright spots in the investment trust space, whether it's some of those kind of so-called wealth preservation funds or alternative assets? But one thing that strikes me about the alternatives in particular is they come with their own very idiosyncratic risks. You've had things like, social housing trusts running into regulatory concerns, or say Tritax Big Box, a really popular logistics trust, has had a difficult time on the back of worries about e-commerce. I mean, does it make sense to kind of try and get a nice spread of those diversifiers just to hedge out those very specific risks that, frankly, I think a lot of people won't see coming?
Well, I really think you've hit the nail on the head there, Dave. Absolutely. You need diversification across these more specialist asset classes. I'm just picking up on something that Ben said. He was talking about gold and he was talking about bonds. And I just think, the wealth preservation companies, companies like Capital Gearing Trust, Personal Assets Trust, Ruffer Investment Company, for an investor, they are holding a defensive portfolio of different assets. They'll have some equities, but they'll have some gold. They'll have quite a high proportion of index-linked bonds. And what they're designed to do is, as it says, preserve your capital. So they're not going to shoot the lights out in a strong market, but in the current environment, they are sort of up 1%, 2%. So they're sort of adding some insurance into your portfolio, and you've got a fund manager there making those choices for you. Looking more generally across the alternatives, absolutely, I think, broad exposure. So, for example, infrastructure, investing in roads, prisons, digital infrastructure as well, data centers, fiber. This has been a very popular sector because it can produce inflation-linked income. These companies have contracts, often with governments, and that income they receive rises in line with inflation. So, of course, that's been extremely popular, and, it's a sort of 5% yield. They are generally on premiums. The sector average premium is 5%, but you can see why people are interested in that relatively stable income. Talking about interesting things, renewable energy infrastructure, I mentioned earlier, has had obviously a wonderful year, up 15%. They are investing in wind farms, solar parks, energy storage, hydrogen. But clearly, also, obviously, the war in Ukraine, we will have to be more self-sufficient for energy, but also we are looking for greener energy. Now, interesting, the government announcements, so talking about issues, we have the government announcements, we know there's going to be some sort of price cap. We don't have any details yet. I mean, the reality is stability going forward on the price would be helpful for these companies, but they've obviously been making very big profits recently because the energy price has been so high. So, it is a sensible idea to have a diversified portfolio of equities and some of these alternatives. And I have to say, I totally agree with Chris and Ben. We don't know what we're facing, but let's just think where we've come from. We've come from the pandemic, when everything was literally shut down. At one stage, it was, very scary, and the market was plummeting, and we have come back strongly. And that's what I think investors have to remember. We're investing here for the long term. There's always a worry. There's always a concern. There's always an opportunity. Have a broad, diversified portfolio. Don't get carried away with all these economic difficulties and throw the baby out with the bathwater. Keep that diversified portfolio.